Come on. 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, January 15th, 2022. It's been another great week of shows. We're going to take a look back at some of our best segments for the week. On Monday, we learned how pension funding improved in 21, but companies may still abandon them. Let's take a look.
Yeah, so this is the Biden administration essentially, coming in and doing something that's not quite regulatory, but what we often refer to as sub-regulatory guidance to fiduciaries and plan sponsors who are in charge of making investment decisions or offering investment, what they call designated alternatives to participants in 401ks or 401k-like plans. So this supplemental statement that the DOL has issued essentially says that unlike what the Trump administration said, which is that private equity investments will be treated just like any other type of investment in a 401k style plan, it might not be, according to the Biden administration, appropriate for small plans. In other words, private equity created finicky part of the market. And it may not be the case that, fiduciaries in small plans have the expertise or are able to hire on the expertise to be able to make decisions that would be in participants' best interest. At the end of the day, ERISA, the Employee Retirement Income Security Act, requires that fiduciaries in charge of these kinds of plans both make prudent decisions about investments and that they are making those investment decisions in participants' best interests. And often, mistakes can be made not because they are, a fiduciary is making a decision that is solely necessarily intended to be against a participant's best interest, but it can be accidentally against a participant's best interest. And when you're working with private equity investments that are not on your traditional stock exchange, those kinds of mistakes may be easier, especially in smaller plans. We expected the Biden administration to do something that would reverse, what the Trump administration had said on private equity. On one side of that camp, that could have been in the form of rulemaking that outright prohibited private equity, created private equity as a prohibited transaction within 401k style plans. Or on the other camp, not touch it at all. I think what the Biden administration has done here is kind of split the middle. They have found a way to say, look, we're not saying private equity isn't entirely allowed, but in your average small 401k that I think a lot of participants are in, it's probably not the best decision. They haven't prohibited it. They haven't said that small 401ks can't provide private equity investments as a designated alternative, but they have said that it may not be appropriate. And under that scrutiny, there might be more ire from the department in the form of investigations or in the form of audits should small 401ks choose to invest in this way. And you're right. I think this all kind of stems from that 2020 information letter that the Department of Labor issued, I believe, in June, and essentially that was an information letter that was requested by stakeholders. So in other words, you had private equity firms that were going to the Department of Labor and saying, "Look, we're doing this. This is something that exists as a designated alternative in some 401k plans. We want to ensure that is within the constraints of ERISA. Is this allowed? Can we continue to do this?" And what the Trump administration, said was, yes, look, we're going to treat this like any other investment. We're going to make sure that you're being prudent and that you're acting in participants' best interest. And otherwise, move on ahead, full steam ahead. But we got an idea, even under the Trump administration, that this may not be the final word on this, because the SEC came out just a few months later and said, look, this might be something that we need to investigate, because we might be likely to see a lot of registered investment advisors working in the 401k space more than ever who work with private equity firms. Private equity, as I've said, it's a thicky business. There is a lot of room for abuse. I'm not saying abuse happens a lot, but there's room for abuse. And so I think a lot of these regulatory agencies were a little uncomfortable once the Trump administration had issued that first letter. We're now seeing the Biden administration, take one step further.
And retirement plans are betting big on private equity. What's it all mean? Let's take a look.
So as you might imagine, going into 2020, right, in January timeframe, I think there was a lot of bullishness in the market. We thought, the economy was sound. There were late 2019 some reports of a new virus strain, but I don't think many of us, to pay too much attention to it. And then obviously the world changed beginning in mid-February, and then I think for most people, the economy just shut down in mid-March. So leading into that second quarter of 2020, the markets were very volatile. There was a lot of loss of paper value. But then surprisingly, the markets had a very sharp V-curve recovery. And so the good news is that for many pension plans, I would say the vast majority of pension plans, as they look to close out the fiscal 2020 or fiscal year 2021 year, the markets have been really good to them. And so I can tell you on one of the pension plans that I sit on as a trustee, the fiscal year ends on June 30th, and we're certainly going to have double-digit returns. It's just a matter of how high that double-digit return is. Having said all that, as Jeff, as you well know, public pension plans, we're long-term investors. We don't ride the highs and we don't get, depressed in the lows. And so overall, we think the fundamentals of the economy look great over the near term, and that's what we're really investing in.
And if you just look, like most people think that because of the pandemic that we've really, decreased our assets. However, Ohio Police and Fire, in the last 3 months, we continue to have gone up. We were at like 17.6 billion 2 months ago, and we ended May at $18 billion. So, there were people that were going to think that this pandemic was going to greatly decrease our assets, have a very negative impact on it. But Ohio has seen a gain, I think, which is very good. I think you're seeing that around the country as well.
So I would say for trustees, what is the new normal in the post-COVID world, right? So what are the new risks? What are the old risks? How is the economy going to rebound? What are the new opportunities within this new economy post-COVID? I think those are sort of the broader questions that trustees as policy setters of pension plans are thinking about. In terms of sort of the administrators of pension plans, I think absolutely those types of concerns, particularly, from staff on the investment side of the shop, so the chief investment officers and all their employees on that side of the shop. The administrators, I would say they are also focused beyond all the investment side about how pension plans fit in this new work environment, right? I think all the conventional wisdom says that sort of office work is going to be completely different in 2021 and going forward, right, as the economy opens up. So I think pension plan administrators, the executive directors and the CEOs, they're really learning and trying to figure out what is the best solution for their employees and the people that they serve, like Kathy and others.
I know that's a big concern for a lot of the pension systems, but not just for the workers themselves, but now the members that used to attend the meetings to stay informed. They're older. They tend to be older. They're afraid to actually go out because of their concerns, even though, that they've gotten, the shot or whatever, that if they go out, a lot of them don't want to leave their residences. A lot of them are afraid to get any information unless it's on the internet or actually from a meeting. And a lot of information was lost during the pandemic. That was one of the biggest complaints that we're getting now. And I think it's not just going to be the workers that are actually at the pension system or the administrators, trying to bring them back, within discussions amongst the workers themselves, as far as trying to figure out what's going to be an easier way for them to communicate. It's also how we're going to continue to communicate with our members in a totally different environment to keep them engaged. A lot of them don't have, up-to-date technology. They're not able to take part in a Zoom meeting. They're not able to bring anything up on a laptop or anything. So we're really trying to find ways, and we continue to communicate with the members so they feel like they're still engaged with their pension system and that they still understand what's going on and they're not left behind. And I think it's key for not just the administrators, but also keeping the members of the system actually engaged and involved.
Hey, Jeff, could I just jump on the point that Kathy raised? Yeah, so I think Kathy raises a great point. And, I have conversations with plan administrators regularly since the shutdown in 2020. And, first things, not every single pension plan has, made its payments to the retirees. Even during this crisis, every single retiree got their pension check. I think that's a significant achievement on the public plan side. It shows the nimbleness and the ability to harness technology that public plans have, from the largest pension plans like CalPERS down to smaller municipal employment-based pension plans, so that every single retiree got their pension check. And in some ways, while Kathy raises very good points about some segments of the retired population not getting the information, for the vast majority of retirees, they actually found the remote sort of Zoom, board meetings very helpful. Like, not only the trustees, but just regular members and participants of pension plans. They could easily tune into the Zoom meetings versus in the past where they had to actually go into the boardroom to attend the conference or to attend the regular board meeting. So I think there's sort of trade-offs, but I think on the whole, I think people on the public plan side have all adopted from plan down to the participant.
Yeah, I would say that the members that have had to educate themselves or go out and decide to get a different phone or to get a more updated laptop have greatly benefited from it.
Yeah, so Jeff, my organization, which Kathy sits as the president or the chair of the board, we've done annual surveys of our membership for the past decade. And what we've consistently seen is that in terms of sustainability of public pension plans, particularly since the great financial crisis, plans have really, tightened down their assumptions, really made changes to both their asset allocation as well as expenses, so that it's paying dividends even through the COVID volatility. So beyond just the return of the 2020 or 2021 that we're seeing, I think just overall, one of the benefits or the silver linings that we came out of the great financial crisis is sort of this tightening of assumptions, which leads to plans, I think having better funding ratios. I mean, obviously there are more than 5,000 state and local pension plans in the United States, so we're not a monolithic group. Having said that, in terms of sort of averages, the average funding status for state and local pension plans, the last survey that we did, which was for 2020, it was around 75%. So not 100, but I think the trend lines are looking very good.
Well, those are certainly great segments. When we come back, we'll take a look at two more great segments from this week's shows. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. This week we also discuss public sector workforce trends in 2022. A lot's been changing. Let's take a look.
Yeah, we've been doing this this trend series for a little over a decade now. And what we like to do is reflect on the past year's worth of research and really put it in a digestible format so that we're able to provide sort of strategic considerations that state and local leaders should be thinking about for the year ahead as they look to make their governments employers of choice going forward. And I will say it's sort of a lot of the recommendations that we'll talk about are really, they really coalesce around retention, recruitment, and sort of the underlying diversity, equity, and inclusion considerations going forward as well. This trends piece comes out at a time against the backdrop of, you look at job openings, for example, between mid-2021 and the end of 2021, it was the highest level of job openings we've seen in the state and local sector since at least the year 2000. On the quit side, pretty much from the middle of 2020 all the way through the end of 2021, it was the highest level across that whole period of the highest level of quits since we've seen since at least 2020, the year 2000. And then when you reflect on some of our surveys that we've done of human resource directors, we've seen the highest levels of their answering that their retirement eligibles are actually retiring at an accelerated rate that we've seen since we've started doing that series. So there are a lot of considerations now in terms of where the sector is and how the sector is ultimately going to be able to be in a position to recruit and retain folks that they need to fill those important skills and roles and responsibilities. We've been doing a series of national polls of state and local workers every 6 months since the beginning of the pandemic. And what we've seen in our most recent polling is 50% of state and local workers do not feel that their pay and compensation matches the risk that they were taking throughout the course of the pandemic in providing services to the public. So I think that's important to focus on. And that's translating into a little under a third, 31%, considering changing jobs as we move forward out of the public sector. So these burnout is key. The fact that you bring up EAPs, the fact that we're focusing a lot on health and financial wellness programs, flexibility in work arrangements, which I hope we could talk about a little bit more in the interview. There's a lot to focus on, but it's important for state and local leaders to focus on mitigating the challenges brought on by burnout. There's a really good news story here. In 2021, well, let me first say, our partners at Boston College's Center for Retirement Research, NASRA, GFOA, and the Institute maintain the Public Plans database, publicplansdata.org for anyone interested in diving into the data. And it allows us to track a range of variables for the top 200 state and local pension systems. And in fact, we're adding new defined contribution plans going forward. The good news story is in 2021, we're seeing the aggregate funder ratios for public plans be about 75%. And this is up from 72% a year ago. Also, we're seeing about 95% of the required contributions that need to be made by public employers being made to support those benefits. So DB plans in the aggregate are well positioned going into the new year. Now, you mentioned defined contribution plans. We're seeing expanded roles, not only on the primary side, of course, the various states and localities offer defined contributions as primary plans, but on the supplemental side as well, in terms of rounding out increased importance in these DC plans to round out the retirement security of public employees going forward.
And we also discussed a jump in mortgage rates in early 22. Let's take a look.
When you put things in perspective, it's really not that ominous, because here's what's going on. If you look at where rates are today, even though they are up, we're still lower than we were pre-pandemic. So that's good news. Bad news, looks like rates will probably continue to move up a little bit more, simply because jobs and employment outlook looks fairly good as far as full employment, or at least close to it. The Fed's signaling 3 rate hikes in 2022. I'm sorry. Goldman Sachs just came out and said they think it might be 4. So, when you look at rates where they are today, historically, still really, really good. I always make the comparison that, people always lament over, oh man, look at gas prices. It's whatever, $2.90 a gallon. Well, a few years ago, it was $4 a gallon. A couple of years ago, it was $1 something a gallon. It goes up, it goes down. But again, when you look at things in historical context, rates are still very competitive. But, do I think it's a good time? Yeah. Again, we've talked about this a million times. If you're emotionally and financially ready, now's a great time to do it. A survey just came out. I was reading this the other day, and it's pretty interesting. About 56% of would-be home buyers feel urgency to purchase now because they're worried about rising rates. Not necessarily a great thing, because now you're putting an emotional aspect into a financial decision. But, again, it becomes the fear of missing out, right? FOMO. But I think also when you're looking at it, there's some people who think that maybe this is a good thing. Maybe this will quell some of the demand, and maybe home prices will stabilize, and maybe the competition won't be as much. But most economists and most surveys are saying that this is going to be another pretty strong year for housing. If your payment's going to go up $100 a month and that's going to cause you financial stress, then I think you better sit down and really look at your budget and find out, is home buying offer, for you? Because think about it, you could lock in a 30-year fixed rate, right? And then 3 years from now, your property taxes go up $3,000 a year. Your homeowner's insurance goes up $1,000 a year. If you're worried about, oh, wow, I missed out because rates were X and now they're a little bit higher, now my payment's $75 a month more. That could be anything. It could be your utility bill, could be what your monthly budget is for gas just to drive to and from work, right? So if you're really worried about that, then I think you really have to think, is now a really good time for you to be a homeowner? Because again, when you rent, everything's pushed on the landlord, right? You know that you signed a long-term lease, nothing's really going to happen. But when you own, everything's on you. So you really have to have that extra money in there. Just, again, have that peace of mind knowing that there could be some increases. For a rule of thumb, I think what you look at is, can you afford the new payment? Is it going to offer you different things? Because there's some intangibles there too, right? If you're selling your first house and buying another one, maybe it's a bigger house. So ostensibly you're going to have a higher payment. But is your family growing? Is it closer to work? Maybe it's further from work, but you're working from home now. So there's all those other intangibles that go along with it. But I would tell people, look, sit down, look again, on paper, what are you comfortable with? What income and outgo? And then figure out, are you able to still to put away that? They used to say 6 months of reserves. Right now it's 9 months. Put away those reserves. And then again, figure out, your utilities can go up, your taxes will go up, your insurance, all those other things that go up. So just make sure there's a cushion there as well. But you really don't want to be house poor. Reference what we said earlier, back in the 80s, people are just like, you know what? I'm sure we'll make it work. We'll just roll the dice, buy the house, and we'll make it. And people made it work, right? But then again, what was the average home price? 50, 60,000. So now, granted, rates are 16%, but now the average home price is 300,000. The mortgage rates are what, 1/5 of that. So I mean, when you look at these things, everything's different. Our property taxes today are probably what our parents paid, for 10 years when we were growing up. So, I mean, all those other factors go in and make, affordability. And that's the one thing, as rates go up, affordability is a big question now, because, when you look at rising home prices and then potentially rising interest rates, will income rise as quickly? So that's, again, it's very, very important to sit down and figure out with your significant other, whoever you're buying a house with, and just make sure, okay, look, here's everything that's going to happen. Are we good with this? And this is where a competent loan officer and realtor is going to come in handy, because they'll be honest with you and tell you what's actually going on and what to possibly expect, and help you with the question you asked about budgeting. Yeah, I mean, there's two thoughts here, because if prices have risen dramatically, and some studies say that we saw 19% increases nationwide last year, do they have to increase taxes? No, they can tax you on a new higher value, and they still have more revenue coming in, right? In Maryland, where I'm at, it's interesting. Maryland has a very, very unique way they handle property taxes. And actually other states and even other countries come in and study it. What Maryland does is divides a state into thirds. And then every 3 years, that third, they get the assessment. So it gives you a little bit of a budgeting thing, because that you're pretty much protected for 3 years, assuming you come in the same year, right? If you buy in the second year in that district, that's and go into the third year, you only have 1 year. But case in point, the next year, you got 3 years locked in, right? So that's a good thing. But yeah, I mean, I would say that the cost of goods, everything else, services going up, I could see maybe them raising the mill rate in some areas. What's interesting on a segue for this is that FHFA, which oversees Fannie and Freddie, they've come out now and said that loans delivered after April 1st, if it's a second home, they're going to actually increase their fees on that particular loan product. So if you're thinking of buying a second home, not to rush into it, but something to think about. If you think, we're going to buy in the next few months, you might want to accelerate that process just a little bit, because you'll save yourself quite a bit of money.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to? Drop us a line. And don't forget, for all the information in lifestyle, wellness, tech, finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives or see our latest content? Then check out our streaming partners, Amazon, Roku, Samsung, and over 100 more. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a tax doctor now for a tax emergency analysis.
Call 800-224-6439.